Welcome back. I'm Pratap here. Today is the 12th November 2024. In this video, let us evaluate the performance of high liquidity zones generated by our NeoStock software. Even before that, all of you please understand, we are providing complete free training on supply demand zone price action. All the training videos are available at our NeoStock YouTube channel. So at our channel homepage, you click on the tab posts. Some of you might be seeing the tab community. Click on the tab, then you get access to our free training course. And this post is having a YouTube playlist link that will take you to all the training lessons. You just click on the link. Now we are into the playlist supply demand zone price action course. Here you have all the training lessons are available. You just need to scroll down to the bottom of the page. Here, starting from lesson 1.1, all the training lessons are placed in an order. So please go through all these lessons one by one and strengthen your skills related to supply demand zone price action. I have also provided the link to our Telegram channel in this video description. So please join at our Telegram channel, and link is available in this video description. And it will be helpful to you each time when we release a new video or any other important updates we will be providing at our Telegram channel. Now let's get into the analysis discussion. Yesterday, end of the day report, we identified 4 high liquidity zones from daily and 75 minutes time frame. We got only short trades yesterday. We didn't get any long related trades from our report. And in that, Metropolis, we got one successful trade before this entire high liquidity zone is violated. First, let us see how we fine-tune this zone. So this is a rally candle. We have 4 base candles, and then you have a drop candle. This is how this high liquidity zone is identified by our software. And this zone we fine-tuned with 15 minutes time frame. Here you have failed ERC candle as a drop. This is the leg-in candle. You have one base candle, and then again you have a drop candle, leg out candle. And this failed ERC candle also you can use as it, because this is looking like a drop. If you look into the dynamic view, sharply once it reached the prices here, after that sharply the prices went down, and the body of this failed ERC candle is moved out of the zone. So this is the drop 1, 2, 3, 4 and then drop. The 15-minute zone. What is our hope? We can find a fine-tuned 5-minute zone here. But if you look into this, we didn't draw any 5-minute zone. That means the structure is not good and this zone will be violated. But here we found a fine-tuned 5-minute zone. So let's identify by getting into the 5 minutes time frame. Now we are into the 5 minutes time frame. See here the first one, the top one. Here you have a rally candle, and then you have a drop candle. In between, no base candles. Lesson 16, you learn this scenario. Such kind of zones will be violated easily because there is no institutional order flow. But here you have an institutional order flow. Rally, base, drop. And moreover, this entire order flow is inside the high liquidity zone. Completely inside. Even if it is overlapped, a part inside, part outside also we will consider. But this is completely inside the real order flow of our high liquidity zone. And it is a fresh zone. It is not tested earlier. And today only prices entered into here. But before that, what is our target? 15 minutes target. Here you have a rally, 2 base candles and a rally candle. This is the 15 minutes target. But did you notice? Before reaching into 15 minutes, just before, a little higher, again prices were started moving. That means failed to reach 15 minutes target with a gap, a small gap. This is one point you have to observe. Let me go to the 5 minutes time frame, you get better clarity. See here, in this candle. This is 9:15 candle, but we got trade in two candles. 9:15, 9:16, both the candles we got. So this is a perfect trade, no doubt in that. And sharply this particular, because order flow is here, sharply it pushed the prices almost close to this 15 minutes target zone, a little above. I think it's about 3.5 rupees above from this zone. Again they were started moving up. That means bulls took the control from this area. Go to the 1 minute, you get clarity when exactly you get the trade. Because 9:15, exactly 9:15 candle could be a risky one. But see here, 9:15 candle is closed inside the zone. After that 9:16 candle also there is a wick entered into this zone and then again it came down. It's a clear trade you get. There is no freak trade here. There is no question. Because candle itself closed inside the zone. Next again it opened with gap down. Next candle again moved up. Once again it gave another entry and then came down. And it gave you 1:4 RR, 1:3.99. That means 1:4 RR it gave. And remember, 1:3 RR is a successful trade for us. Because sometimes some trades may not reach 15 minutes target. They fail. There could be several reasons for that. Today also it failed, but came very close to the 15-minute zone, but didn't touch this particular zone. So I can say it is a failed to reach 15 minutes target. But can we say it's a failed trade? No. If a trade reaches minimum 1:3 RR is a successful trade. This is what we discussed several times. Minimum 1:3 RR. If it did not give minimum 1:3 RR, we will call that as mostly it is a failed trade. Still some people will make profits using 1 minute trailing stop loss. That possibility is also there. Suppose because it is failed, is there any possibility that we get profit here? Yes, here you have. See here you have a rally candle, 2 base candles and a drop candle. Those who use 1 minute trailing stop loss, who are aiming for reaching this 1 minute, and if it is failed, probably some people will exit like this. The moment this is violated, they would have exited here. Some people after reaching 1:3 RR, they will, where we are getting 1:3 RR at what level? Here. Some people would have exited here because it achieved 1:3 RR. And those who are aiming 1:4 RR, probably you would have achieved here 1:3.99. So it's almost 1:4. They would have gained the maximum profit. These are the different, see, this is the maximum profit it has given today is 1:4 RR. Because slightly it failed to reach, excuse me, because just before reaching this, some people keep some considerable buffer and exit the trade. Probably at this level they might have exited. Some people keep very narrow buffer, slightly they missed, so probably at 1 minute trailing stop loss they would have, because the nearest to the 1 minute trailing stop is this rally base drop. See, these are the different techniques people will use for exit the trade. But for us it is a successful trade because it met our minimum criteria 1:3 RR, and the maximum profit it has given is 1:4 RR. It achieved it today. So how much profit it has given? Metropolis has given 11,180 rupees. It's a huge profit. And 6.3 ROI it has given. Till 1:4 RR it is 6.3. If it is 1:3 RR, probably you might have got around 9,000. Still you would have got either what to say 5.8 or 5.9 RR you would have achieved. Those people who exit at 1:3 RR level. But this is the maximum profit it has given. Actually, one point I forgot to write in the comment section. Achieved 1:4 RR. Failed to reach 15-minute target. These are the things we have to observe from this trade. Sorry, failed to. Then only it is an appropriate to consider. There is one more point I forgot to tell you. Because our intraday average ROI is 6%. Some people may at 6% ROI level, they may exit, some people. See, these are the different ways people behave. But ultimately what we consider, whether it is reached 15 minutes target or not. No, it failed. It failed to reach 15. That's why we log at this point. We failed to reach 15 minutes target. Okay. To make it a successful trade, how much minimum RR is required? 1:3 RR is required. Is it achieved? Yes. So it's a successful trade. What is the maximum RR it achieved? 1:4 RR it is. That is 1:3.99. I rounded it to 1:4 RR. Okay, after that what happened? Now, again all of a sudden, bulls dominated. The price has moved and this 5-minute zone is violated now. And some resistance it got at this 15 minutes zone, but some push it gave. After that, this zone is easily violated, because we know this zone will be violated easily because there is no order flow here, the 5 minutes order flow, because we always focus on 5 minutes to confirm institutional order flow. There is no proper order flow. After that, again prices moved up and again came down. Maybe the reason here is 75 minutes they created a zone, rally base drop. A new 75-minute zone is created. That means here again there are no bulls control here. So bears took control here. Here bulls took the control and pushed it. But high liquidity gave you high liquidity in between. See, the complete domination of the bulls. But still we got the trade because our high liquidity fine-tuned 5-minute zone, some institutional order flow is there. Even though bulls dominated here, still we got good trade opportunity to push the prices close to the 15-minute zone. Slightly missed with a gap of 3.5 rupees, because it is a 2000 rupees stock. 2000 rupees stock and 3.5 rupees is a small amount only. It's like a buffer. Okay, anyway, this is a successful trade because it achieved 1:3 RR. And the next one is NMDC. This is the one slightly we missed the trade today. Sorry, not NMDC. It is Coromandel. Sorry, Coromandel. This is a 75 minutes high liquidity zone. This one we fine-tuned with 15 minutes time frame. We have a rally base drop is there, the 15-minute zone. Here you have again a 5-minute zone this is acting as a high liquidity zone. How can I say acting as a high liquidity? Because multiple test. Where is multiple test? Only one time it is tested, you may say. No, because I reduced the risk. Because the risk is more than 2.5%. What is the maximum accepted risk? 2%. See, if I draw a zone like this, base candle 1, 2 and 3 and then drop candle. This is a rally candle, leg in. If you draw this risk, you see here it is multiple tested. This is the first time, again second time, again third time. And today again fourth time it entered into the zone. It is a clean trade today. Get into the 1 minute, you get clarity. See, this is a morning 9:15 candle. Okay, 9:15 candle is a lucky trade, you may say. The next 9:16 candle. While close, and moreover, price almost closed near to the zone. End of the 9:15. It is even 9:15. It is a clean trade. At the closing hours of 9:15 candle. Again 9:16 candle, prices opened. From there it came down. And then finally it reached the 15 minutes target. You would have got a very good profit. You have a rally, base rally. Reached it. So here it got the trade and reached the target. This is a 5 minutes high liquidity trade. But why we didn't consider this trade? This is the question you have to ask. The reason why I did not consider, this is beyond our minimum accepted risk. If you take entry at this level, if you draw a zone like this, and if you calculate the high and low of this zone, it is coming 2.7%, something like that. ROI it is achieving. What is the maximum negative ROI we can accept? 2%. That is loss. Negative ROI is our loss. You can't accept beyond 2%. That is our risk management in our system. Even if you miss the trade, it's not a problem. But you should not break the rules. It is a high liquidity zone. That's why I'm saying it is a high liquidity zone. But what I did to minimize the risk, I have drawn the zone like this. This is within our accepted level. This is the one. Rally to base candle. Actually, this is also a base candle, part of the zone. But the move started from here. That way I consider. This is the place the move started. This is the way I have drawn the zone. See, previously also prices came here, rally, base, drop. But this drop candle is not a very considerable drop candle. This is also looking like a medium size candle. But if you really look into this, some price action took place here, like a rally, base, drop. LOTL zone. Such kind of activities will take place only in high liquidity area. So that's why our plan is to take a trade once prices enter into the zone. Now risk is within our accepted limit. This risk is less than 2%. But today what happened? Prices reached up to here. It didn't enter into this zone. So due to this reason, you can't take this trade as a successful trade. If you are granting this trade, this is beyond our accepted risk, that is beyond 2%. Beyond 2% is against our supply demand zone theory concepts. Of course, if you are taking trade in cash segment, you can take this trade in cash segment. How? By doing position sizing. Of course, in F&O also, I remember recently one of the members asked this question. How do we do position sizing in F&O? See, if you are taking 1 lot, 2 lots or 3 lots, you can't do position sizing. If you are a big investor, you are taking 10, 15, 20 lots. At the time you can do position sizing. Your entire capital is only for using for buying 1 lot. You can't do position sizing. Cash segment you can do position sizing. So those who are planning your trade in the cash segment, they can do position size. Even though risk is beyond 2%, still you can limit your risk to within the 2% level by reducing the by reducing the number of shares. The position sizing concept you learned in lesson 18 or 19. In one of these lessons you learned. If anybody remember the lesson number, please put them in the comment section. In which lesson you learned position sizing. So position sizing, it could have been a successful trade. You would have got a good profit. But remember, when you are doing position sizing, your whatever the capital, you should not release the capital. You have to block the capital, entire capital. That means if your capital is, say for example, 1 lakh, when you are doing position sizing is recommending you to buy only 75,000 rupees worth stocks. So remaining 25,000 rupees you should not release for buying some other trades. That is not position. You have to block the entire capital. On 1 lakh capital you are doing position sizing. And position sizing concept recommending you to buy worth 75,000 rupees stocks. Because if you get a loss, the loss is limited to 75,000 rupees worth, but your entire capital is 1 lakh. On 1 lakh we are calculating the loss, even though you are buying 75,000 worth. That means in entire 1 lakh, your loss is limited within 2% level. That's why you should not release that capital. The same points are clearly explained in the position sizing video lecture. Many people do these mistakes, even experienced people do these mistakes. Because over a period of time they ignore the fundamentals. So those who have done position sizing, probably you could have got this trade as a successful trade. But this is a HLQ, 5 minutes HLQ trade, but this is a fine-tuned zone. Those people who took 5 minutes entire risk level, probably it could have been. But F&O, if you are buying 2 lots or 3 lots, you can't do position size. Definitely you should avoid this trade. So okay, F&O point of view, I am considering, that's why I am not considering this as a trade, because it is beyond our accepted level. But remember, cash segment people still can take a trade from this candle, and you would have reached this 15 minutes target. Okay, this is about Coromandel, and remaining 2 we didn't get any trade opportunities. One is a Naukri. This is a daily zone. You have a drop, base, drop. Remember, Naukri, this is, I didn't fine tune this zone. This is the one we fine tuned earlier, probably on this candle, this one or this one, probably on 6th November or 7th November. Our software might have given recommendation. That means on 7th November or 8th November analysis videos, you can observe how I fine tuned this zone. I didn't change anything, the same thing. Okay, in case if you don't remember, let me quickly explain. This daily zone is fine tuned with 75 minute zone here. I consider this as a leg-in failed ERC candle, 3 base candles and a drop candle. So this is the 75 minute zone. Within the 75 minute zone, again I fine tuned with 15 minutes time frame. This is again a failed ERC candle as a leg-in, 1, 2, 3, 4 base candles and a drop candle. Then again this fine-tuned 5 minute zone, further fine-tuned with 5 minutes level. If you look here, the structure is not at all good. This is the area, 5 minutes level. But here you see, you have a drop, 2 base candles and a drop candle. This is the 5 minute zone as an horizon to this fine-tuned 75 minute zone and also this fine-tuned 15 minute zone. This is the area you can find the actual order flow. Because from this order flow it picked up and the entire zone is created. Even 75 minutes also, the leg out formation is started from here only. I mean the daily zone, what I mean to say, this entire daily zone. So this is the area. You have the real order flow. That's why our trade plan is on this 5 minute zone, which is the origin for this entire 75 as well as a 15-minute zones. But today also prices did not enter into this zone. Go to the daily candle and look into today's candle. So that's why we didn't get any trade opportunity. Remember, this is the zone we already fine-tuned few days back. The same thing I am using again. This is the advantage of drawing the zones on our charts. Next time again, if the prices are near to this zone, we still get the trade opportunities from the analysis we did earlier. And the last one is NMDC. This is also a daily high liquidity zone. Here you have, this is the rally candle at the hidden body. From the previous close, hit the hidden body. This is a rally. You have 1, 2, 3 base candles and then drop candle. This is what identified by our software. This one I want to fine tune with 75, but I didn't get any proper 75 minutes zones. There are no proper 75 minutes zones here. Even here also. No proper. See, this is the failed ERC. After that, all these are all leg candles. No base candles. But what I did, I found a 5-minute zone as an horizon for this entire daily zone. This is also acting as a high liquidity zone also. 5 minutes high liquidity zone. And also this is the zone horizon. So this is the rally candle, 6 base candles, 1, 2, 3, 4, 5, 6 base candles, and then a drop candle. After that again prices moved into the zone and picked up the orders, came down. That was the first test. And again here twice came down and again came down. So far 3 times it is tested, and during the zone creation, or even one more test is there before, let me check. Yeah, there is one more test before the zone creation here. Came very near, I am considering as a tested zone. Because every time price, because order flow, generally they spread a little before the zone also. 4th time, and this is the 5th time. And this is the time actually the zone was created by picking the orders and sharply, see how sharply prices moved. That means more order flow is added in this area. In this area, institutions will keep on adding new order flows again and again. So that way prices moved down. And recently price came very close, but didn't enter into this area. That means order flow is very strong within this area. Maybe your trade may not be successful even if you add some entry buffer also at that time. But it is indicating there is a strong order flow in this area. So that's why our trade plan is only on this 5 minutes zone, which is acting as a high liquidity, and also this is the horizon for this entire daily zone. Look into the daily zone. This 5-minute zone is the horizon for this entire daily zone. From this area it picked up the orders. First you have this rally candle again. After that base candles. And then see how prices are falling down from here. And recently also came near. Didn't touch. Came near to the zone. And again they were falling down. This is today's candle. So we didn't get any trade opportunity. So this is about the high liquidity zone generated from the previous report. Hope this information will be useful to the learners. Let's all meet again in our next video. Thank you.